What's up, guys? We're back. I was busy the past 2 weeks, so we released lesson series instead.
Yeah, but now that we're back, seems like the market is back too. So what are we talking about today?
Let's talk about Powell's Fed announcement from Wednesday and our opinion on it.
Also, let's do Chinese concept. What an incredible bounce.
Definitely incredible and unlikely to sustain for long term, according to the political situation at least.
Before we get to our topics, let's quickly cover our recent positions. I cut McDonald's. I still think that McDonald's, after closing over 800 restaurants in Russia, will recover. But since I have calls from before the war, I have to cut my losses. I also cut JPM for now, and for the same reasons. The war significantly hurt the premium on my calls. So the lesson I learned is that I should have looked into the business in Russia for the companies I'm holding. I definitely had a chance to get out before it got real bad. What about you?
Well, I enjoy this pop. I was lucky enough to profit from a couple of Shopify and Tesla call, but I have closed all short-term position going into the weekend. Anything could happen and I don't like surprises.
Alright, now that we got that out of the way, let's take a look at Fed's announcement on Wednesday.
The market dumped at 2 p.m. and immediately pulled back up. What a strong bounce after Powell start talking. Is that why it bounced?
Well, so the dump is likely due to the Fed minutes signaling that economic projection is weaker than expected, even though the rate hike is 0.25 basis point as expected. So must be the economic projection, right? Looking at the Fed board member projection, we can see that the median change in GDP by December dropped from 4% to 2.8%. And on top of that, for the next 2 years until 2024, GDP growth will continue to slow down to 2.2% and 2%. So long term, we're projecting economic growth slow down.
Looking at the range in 2022 to 2024, we can expect to see as low as 2.1 in 2022 to 1.5 in 2024 as worst case scenario. Doesn't look good at least for now, but you might be thinking the reason the GDP is dropping so hard in 2022 is because of QT. Quantitative tightening, and relatively we might be growing faster than usual. So can we compare 2.8 against historical GDP growth to get a bigger picture?
Here's your bigger picture. Starting from the housing crisis in 2008, which was negative 0.13 and negative 2.5% in 2008 and 2009. And COVID in 2020, which was negative 3.4, the 10 years in between from 2010 to 2019, the average GDP was 2.3%. And even though the chart is not showing 2021 data, but according to BEA's number, the US GDP growth in 2021 is 5.7%.
So if we omit the negative, which we can count as an outlier for Black Swan event, 2.8% GDP growth is the fourth fastest growing years, and faster than the average of 2.61. If you don't count 2021's 5.7, then the average dropped to 2.3%, which is much lower than 2.8. So in 2022, we are still growing at a relatively fast pace.
So I think you made a good point. In 2022, we're consistent in terms of economic growth despite reducing the projection from 4% to 2.8%. I don't think this is a sign of slowdown, at least in 2022.
There have been a lot of talks about slowdown in growth and the impact of rate hikes on the economic and the market by extension. At least from the data, I agree we can still see that the economy is not slowing down just yet.
So in terms of investing, that is the bottom line, right? For most cases, the company we're investing in can continue to be profitable only if the economy is growing. If the economy is slowing down or worse, not growing, the people are spending less. Where's the growth we're seeking? And for companies with no or negative growth, I think everyone can imagine where the stock is going.
Exactly. But remember, that's if you are long-term investing. If you are day trading, that's another story. But if you believe in Fed's projection, it is telling you that in 2022, we are not losing steam just yet. But after that, as you can see in 2023 and 24, the GDP growth drop below past average. Not to mention a lot can change until the end of 2022, but so far we are getting close to being in the slow down area.
And also, don't forget that we are expecting to keep hiking rates until the end of 2022. So the projection for the next 2 years will likely change. Since we'll be hiking rates likely until the end of 2023 to early 2024, there's a good chance that will hurt the economic growth. So we will have to keep following the projections.
I know a lot of you probably thinking, shit, then we are crashing within the next couple of years. Chill, that's not what we are saying. Slow down doesn't equal a market crash, but market can correct, just like individual stocks and indices all can correct. It is actually not normal if it doesn't correct with the expected economic growth.
I think so too. If a company is overvalued and it's not dipping or returning to its fair value zone, I think that's not normal. I'm with you on that. But as long as the profitability is not slowing down for a company, it will not dip forever.
And we will keep you updated on what we are scooping up. So keep watching and let us know if you like or not like what we are picking up.
Exactly. But back to our original question, why did it dip on Wednesday? I feel like we sidetracked a bit, but I think it is important to know that anyway. But to us, the dip is because Fed announced that they are expected to raise rates to 1.9% by the end of 2022, which was higher than what everyone expected and was considered hawkish.
Makes sense? But then the market said, psych, and bounced back 30 minutes after. What happened there?
Of course, everyone loves Powell. Gotta support, you know? I'm just kidding. These are some key points from his speech. The federal fund interest rate rising continuously is appropriate, and if inflation signals that we need to hike rates faster, we will. And then the Fed will reduce the balance sheet to ensure inflation won't stay up, and basically the Fed will use every tool necessary to maintain price stability.
He also said we will reduce the balance sheet faster and will start as soon as in May. But here's what gave the market confidence. He said that the Fed is not seeing prices and wages spiraling up out of control. In other words, we likely won't see the infamous stagflation, and he or the Fed think the economy can sustain with QT policy starting now.
Yep, he also stressed that the economy is strong now and the chances of recession is not high. So that's why the market bounced, I guess. The market still chooses to believe the Fed even after the Fed keeps saying inflation won't keep going up when inflation was at 3% way back in 2021.
What? Who else are gonna believe that though? But personally, I think the fact that the market has pulled back a lot since the beginning of the year, a lot of companies are close to fair valuation and at a way better price than beginning of the year. So it makes sense to bounce with a better risk-reward ratio.
So on Monday, JP Morgan China Internet analyst Alex Yao and a team said they consider the sector uninvestable for the next 6 to 12 months and downgraded 28 of the stocks they covered.
You know what I think? I say they are trying to accumulate more shares. These bastards. But anyway, Chinese stocks were skyrocketing across the board Wednesday on news that Beijing is going to chill on its regulatory crackdown after China's economy grew by just 4% in the fourth quarter and stock prices have plunged.
Honestly, I don't get what the Chinese government is doing. Why do this bullshit to restrain the nation's most successful companies?
Well, they did say that the crackdown was intended to boost both social equality and central government control so these giants doesn't get too big. With that being said, more than 1 trillion in value has been wiped from Chinese stock and Hong Kong's Hang Seng Index.
Yup, it's sitting at a 6-year low right now, but finally, Vice Premier Liu said the government would support the economy and keep markets stable and will actively introduce policies that will benefit markets. What does that mean?
Take a look at yourself. Everything just took off the moment he opened his mouth.
We have a lot of double-digit gainers. At the same time, China is also in communication with the US trying to reach an agreement on auditing supervision rules that could prevent the threat of stock delistings.
Hallelujah. Literally the two main concerns that are holding investor back. But is now a buy?
Well, you shouldn't chase here, I don't think. A lot of people are bagged for a long time, and this is an opportunity for some of them to get out. Also, the delisting risk is still there.
And the pandemic, yeah? You forgot about that one, huh? A fresh outbreak of which has recently led to Chinese government to impose lockdown in the city of Shenzhen for at least a week. Shenzhen is a massive tech manufacturing hub and has one of the biggest import and export ports. This is going to have an impact on the global supply chain again.
It is best for us to wait it out a little. Still, many of these stocks are undervalued compared to their historical levels. And now, with the Chinese government seemingly trying to be nice and stuff to its domestic leading companies like Tencent, Baba, and Baidu, they could actually soar again.
If you are unsure or not familiar with the Chinese individual companies, you can consider getting the largest Chinese tech ETF, KWEB. This is also the ETF I often invest in.
So, like we said earlier, the Fed rate hiking cycle begins. They announced a 0.25 rate hike, and this is the first increase since 2018. And also the first lift off from 0% interest rate since 2015. The Fed expects to raise rates as high as 2.8%. But they didn't say by when. The next meeting will be in May, so we'll see.
Honestly, I was expecting a 0.5%, but considering there's a war going on, it makes sense for them to keep it at 0.25% for now.
Here's a graph showing the Fed policy rate and the Consumer Price Index, CPI, which last month hit a 40-year high. The Fed is trying to play catch up now, and they're expecting 7 hikes this year.
So we are most likely expecting a rate hike at every remaining Fed meeting this year and begin reducing the central bank's 9 trillion bonds holding as early as May. Yet, stock rally like crazy this week.
I like to call this a near-term oversold bounce, and everyone is liking the 0.25% increase.
The Dow Jones closed the week with 5.5%, the S&P 500 slightly over 6%, and the Nasdaq closed over 8%.
If there's no surprise on the ongoing war over the weekend, we should have another up week, but we got some SPY put on Friday just in case we get a small retest early next week.
So share your thought with us in the comments below and let us know what you think. Thank you for watching. If you find this video helpful, feel free to give us a like and subscribe for more content like this.